The Panic of 1837 began when speculative lending across Western lands collided with a sudden collapse in cotton prices, which fell 25% within weeks. Cotton had served as the United States' leading export and collateral for many bank loans, so the price drop immediately undermined credit markets. At the same time, former President Andrew Jackson's dismantling of the Second Bank of the United States removed a central stabilizing authority, leaving state-chartered banks exposed. Without coordinated oversight, lending contracted rapidly, and credit became scarce for merchants and farmers alike. The consequences spread quickly across the economy. Between 1837 and 1843, 618 banks failed, eliminating the savings of thousands of households and businesses. Unemployment reached 15% nationwide, with urban centers experiencing even sharper spikes as factories closed. The collapse halted infrastructure projects, slowed Western expansion, and undermined confidence in paper money issued by local banks. Because the crisis persisted for 6 years, it reshaped the country's financial system and fueled calls for stronger national institutions to prevent similar systemic breakdowns. In October 1907, the Knickerbocker Trust Company, then one of the largest trust institutions in New York City, suddenly collapsed after rumors spread about its risky bets in copper. Depositors rushed to withdraw funds, and within days the panic spread across dozens of New York banks, creating a full-scale run on the financial system. The sudden freeze in credit markets threatened to shut down daily commerce because banks could no longer lend to businesses or meet ordinary withdrawals. This chain reaction exposed how fragile the U.S. banking structure was in the absence of a central stabilizing authority. J.P. Morgan, already the most powerful private financier in America, personally intervened to contain the crisis. He pledged $25 million of his own firm's cash to keep solvent banks open, while the U.S. Treasury quickly added $35 million in emergency deposits to support the system. Morgan gathered leading bankers in his library, locked the doors, and forced them to coordinate rescue loans for weaker institutions. Because of this improvised response, the panic eventually subsided, but the damage was undeniable. The public lost confidence in trusts and unregulated banks. The long-term result came 6 years later, when Congress passed the Federal Reserve Act in 1913 to prevent any single individual from having to manage a national crisis again. Between 1930 and 1933, more than 9,000 banks across the United States closed their doors as the Depression deepened, and depositors demanded their money back. The system had no deposit insurance, so each failure erased household wealth instantly, producing an estimated $140 billion in vanished savings. Because small community banks dominated the landscape and lacked diversification, even minor local shocks pushed them into insolvency, which then rippled through entire regions. The cycle of withdrawals and failures accelerated unemployment and shrank credit, worsening an already fragile economy. By early 1933, the panic reached its peak when state governors began ordering bank closures to stem withdrawals. President Franklin D. Roosevelt responded immediately after taking office by declaring a nationwide bank holiday on March 6, 1933, closing every bank for 4 days. The emergency pause allowed regulators to inspect institutions and separate solvent banks from failed ones, restoring a measure of order. Later that year, Congress created the Federal Deposit Insurance Corporation, which insured deposits up to $2,500 per account. Because of this change, ordinary Americans regained confidence that their savings would be protected, marking a turning point in how the public viewed the financial system. Between 1986 and 1995, the U.S. experienced the failure of 1,043 savings and loan institutions, a collapse rooted in regulatory shifts of the late 1970s and early 1980s. Congress had loosened restrictions that previously limited thrifts to conservative mortgage lending, authorizing them to invest in higher yield and far riskier assets. Because interest rates rose sharply in the early 1980s, many thrifts already carried losses from fixed-rate mortgages, and deregulation encouraged them to gamble in commercial real estate and speculative ventures. The strategy delayed recognition of losses, but ultimately deepened the insolvency problem. By the end of the crisis, 747 federally insured thrifts failed outright, forcing the government to intervene on an unprecedented scale. The final bill reached roughly $160 billion, with taxpayers covering about 70% of that total through the Resolution Trust Corporation. Public outrage intensified when executives like Charles Keating, head of Lincoln Savings, were investigated for fraud after directing billions into speculative junk bonds. Because political figures had received campaign contributions from thrift executives, the scandal expanded into a national debate over regulatory capture. The episode reshaped banking oversight and remains a case study in how deregulation without adequate supervision can magnify systemic risk. In February 1995, Barings Bank, Britain's oldest merchant bank founded in 1762, collapsed after its Singapore operations revealed hidden trading losses of extraordinary scale. Nick Leeson, a derivatives trader only 28 years old, had accumulated $1.3 billion in losses by making unauthorized bets on futures tied to Japan's Nikkei index. Because he simultaneously managed both trading and settlement functions, Leeson concealed the positions inside a secret error account labeled 88,888, bypassing internal checks. The problem remained undiscovered for months, even as his bets widened and market volatility increased after the Kobe earthquake in January 1995. When auditors finally uncovered the extent of the losses, Barings was insolvent almost instantly because the deficit exceeded its entire capital base. The British government attempted to coordinate a rescue but found no buyers willing to assume the risk without massive guarantees. Within days, Dutch banking group ING acquired Barings for a symbolic £1, preserving some operations but erasing the institution's independent legacy. The event demonstrated how weak internal controls and inadequate oversight could destroy a centuries-old financial house. Regulators across Europe and Asia tightened supervision of derivatives trading as a direct consequence of Barings' collapse. On September 15, 2008, Lehman Brothers filed for bankruptcy protection after it could no longer cover liabilities that had grown to $619 billion against $639 billion in assets. The firm, founded in 1850 and operating for 158 years, had expanded aggressively into mortgage-backed securities during the U.S. housing boom. Because falling home prices rapidly devalued those securities, the bank's balance sheet deteriorated faster than it could raise new capital. Potential rescuers, including Barclays and Bank of America, withdrew interest once government officials refused to guarantee losses, leaving Lehman isolated. The bankruptcy immediately erased 26,000 jobs and froze countless trading relationships across the globe, producing chaos in short-term credit markets that banks used for daily liquidity. Because Lehman had counterparties embedded in nearly every major financial institution, its failure spread uncertainty throughout the system and triggered a flight to safety. Within weeks, the U.S. government authorized the $700 billion Troubled Asset Relief Program to stabilize banks still at risk. Lehman's collapse remains the single largest bankruptcy in American history and a defining moment of the 2008 global financial crisis, demonstrating the systemic danger of over-leveraged institutions without credible backstops. On September 25, 2008, federal regulators seized Washington Mutual, known as WAMU, after a rapid bank run drained $16.7 billion in deposits in just 10 days. At the time, the institution carried $307 billion in assets and $188 billion in deposits, making it the largest bank failure in U.S. history. Years of aggressive mortgage lending, particularly subprime and option adjustable rate loans, had left WAMU highly exposed as housing prices collapsed nationwide. Because default rates surged, the bank's capital position eroded, and confidence among depositors disappeared almost overnight. The Federal Deposit Insurance Corporation quickly brokered a sale to J.P. Morgan Chase, which paid $1.9 billion to assume WAMU's deposits and branch network. While depositors were protected under FDIC insurance, shareholders were completely wiped out and bondholders absorbed steep losses. The scale of the collapse underscored how quickly poorly underwritten mortgage portfolios could destabilize even the largest institutions. WAMU's downfall became one of the most visible symbols of the 2008 financial crisis, illustrating the direct link between risky lending practices and systemic collapse. In October 2008, Iceland's three largest banks, Landsbanki, Kaupthing, and Glitnir, collapsed almost simultaneously after years of borrowing heavily from foreign markets to fund rapid expansion. Their combined liabilities equaled roughly 10 times Iceland's annual GDP, a scale far beyond what the government could realistically guarantee. When global credit markets froze, these banks could no longer roll over short-term debt, and depositors abroad, particularly in the United Kingdom and the Netherlands, demanded withdrawals the institutions could not meet. Because Iceland lacked a central bank with the resources of larger economies, insolvency became unavoidable. The collapse caused Iceland's currency, the krona, to lose about half its value in just weeks, raising import costs and accelerating inflation. British authorities, determined to protect local depositors with accounts in Icelandic banks, invoked anti-terror legislation to freeze Icelandic assets, a move that shocked Reykjavik and worsened the crisis. At home, widespread public protests targeted both bankers and politicians, accusing them of reckless oversight and secrecy during the bubble years. By early 2009, the political fallout forced the government to resign, making Iceland one of the first nations where the financial crash directly toppled a ruling coalition. In March 2013, Cyprus became the first Eurozone country to impose a large-scale bail-in as a condition for receiving an international rescue package. The European Union and the International Monetary Fund agreed to a €10 billion bailout, but only if Cypriot banks absorbed heavy losses from their own creditors and depositors. Because the island's financial sector was disproportionately large, 8 times the size of its GDP, traditional state-backed support was impossible without external conditions. Years of exposure to Greek debt and risky real estate lending had left Cypriot banks insolvent when the broader Eurozone crisis peaked. The Bank of Cyprus, the largest institution in the country, seized 47.5% of all uninsured deposits above €100,000, transferring the funds into equity to recapitalize itself. Lehman Bank, the second-largest lender, was shut down entirely, with small depositors transferred to Bank of Cyprus and larger creditors losing nearly everything. Meanwhile, ATM withdrawal limits and strict capital controls were introduced to prevent a full-scale run on the banking system. Because this marked the Eurozone's first direct seizure of private deposits to stabilize banks, the event permanently altered how Europeans viewed the security of their savings during crises. In March 2020, India's Yes Bank, the country's fourth-largest private lender at the time, entered a severe liquidity crisis after years of risky corporate lending. The Reserve Bank of India intervened directly by imposing a 30-day moratorium, citing mounting bad loans that had already generated a net loss of 16,418 crore for the previous fiscal year. Regulators feared that the institution, with more than 18,000 employees and millions of depositors, could trigger broader instability across India's banking sector if left unchecked. Because confidence eroded quickly, withdrawals surged and the bank's capital position deteriorated further. To stabilize operations, the RBI capped individual withdrawals at 50,000 during the moratorium, a measure that restricted depositor access but prevented an immediate bank run. Meanwhile, the government orchestrated a rescue plan led by the State Bank of India, which took a significant equity stake alongside other domestic lenders. This intervention recapitalized Yes Bank and restored basic functionality, but shareholders experienced heavy dilution of their holdings. The crisis underscored the risks of unchecked loan concentration in private banks and led regulators to impose stricter supervision on credit growth strategies across India's financial system. On March 10, 2023, Silicon Valley Bank collapsed after depositors attempted to withdraw $42 billion in a single day, overwhelming its liquidity position. At the time, the bank held $209 billion in assets, ranking as the 16th largest in the United States. Its client base was concentrated in technology startups and venture capital firms, many of which maintained deposits far above the FDIC's $250,000 insurance limit. Because the bank invested heavily in long-term government securities that lost value as interest rates rose, it could not liquidate assets quickly enough to meet withdrawals. Regulators seized control within hours, making it the second-largest bank failure in U.S. history after Washington Mutual in 2008. The collapse immediately disrupted payroll and operating funds for thousands of startups that relied on SVB as their primary bank. Federal officials responded by guaranteeing all deposits, even those above insured limits, to prevent contagion across the broader financial system. Meanwhile, venture capital leaders publicly debated how a bank so central to innovation could fail from basic asset-liability mismatch. The episode highlighted the risks of concentrated client bases and interest rate sensitivity in a rising rate environment. On March 19, 2023, Swiss regulators arranged for UBS to acquire Credit Suisse for $3.25 billion, ending the bank's 167-year history. Founded in 1856, Credit Suisse had once ranked among Europe's most influential financial institutions, but years of scandals and risk management failures eroded its standing. By early 2023, the bank faced accelerating withdrawals as clients pulled tens of billions in deposits, forcing authorities to intervene before its liquidity fully collapsed. The Swiss government provided guarantees worth $100 billion to support the emergency transaction and stabilize the country's financial system. A critical element of the deal was the complete write-down of $17 billion in additional Tier 1 bonds, making it the largest loss ever imposed on that class of securities. Bondholders were wiped out instantly, even as shareholders retained some equity value, a reversal of traditional bankruptcy hierarchies that sparked legal challenges across Europe. The acquisition underscored both the fragility of global banks and the extraordinary measures regulators were willing to take to prevent systemic contagion. For UBS, the takeover created a national banking giant, while for Credit Suisse, the collapse closed nearly 2 centuries of independent operation. The outcome signaled how quickly market confidence can evaporate, regardless of legacy or scale. If you enjoyed this, I'm going to be posting a lot here. I would greatly appreciate it if you could subscribe. Thanks for watching.